Hi guys, Mark Franke here. This video is an overview of Chapter 19 and the concepts in Chapter 19, where we are going to look at the difference between a variable cost income statement and an absorption cost income statement. Absorption cost income statement is the same type of income statement you've always prepared, where we calculate cost of goods sold and then net income. Cost of goods sold is sales minus our product costs minus selling and administrative expenses to get our net income. A variable cost income statement realigns the expenses into their behavioral categories, variable and fixed. So I'm going to start with serial problem from Chapter 19, where we are looking at our friends, the Business Solutions Company, and they are making workstations. I guess these are like computer desks. So we're going to first calculate the unit cost both in total for our absorption income statement and just the variable cost, because we know that the variable cost is going to go up or down based on the number of workstations that we manufacture, and the fixed costs will stay the same. In effect, in a variable cost income statement, we're just expensing the fixed costs. So the difference between a variable cost income statement and an absorption cost income statement is the amount of fixed costs in inventory. In most cases in this chapter, they don't have a beginning inventory, so it's just the ending inventory where there's an issue. But if we do have beginning inventory, that would have to be taken into account. So let's calculate our unit costs based on direct materials of 800, direct labor of 400, variable factory overhead of 100, and then our fixed factory overhead is 80. That gives us our total unit cost, if we sum these up, of $1,380 per unit. These are unit costs. And this is if we manufacture 300 units. Now keep in mind, we're selling 300. Whether we make 300 or we make 320, our income statement is based on the sales of 300 units. So regardless of if we make 300 or 320, our direct materials are still $800 per unit. So our direct labor is still $400 per unit, and our variable factory overhead is still $100 per unit. That's not going to change per unit. It would change in total if we sold 320 or manufactured 320. Now, as far as fixed costs, because we made more, our fixed cost went down to $75 per unit, and you can see the calculation there is the 24,000 divided by 320 units. So, because we made more, our unit cost went down $5, and it's totally because of the fixed factory overhead. We saved $5 because we made more. Now, as far as our variable cost, these costs are still going to be the same whether we make 300 or if we make 320, because this is the variable cost and it's per unit. So variable cost per unit doesn't change. It's going to stay the same regardless of how many we make. Why? Because we need the same amount of direct materials, the same amount of direct labor, and the same amount of factory overhead per unit. So now we can prepare our absorption cost income statement. And we're going to just call this an income statement because that's the way we normally report it, but I am going to just notate it as being absorption. But that's just a fancy word for our normal income statement. And this is for the year ended December 31, 2019. Now keep in mind, what's changing here is the number of units we produce, not the number of units we sell, because we're still selling 300 units, and the selling price is $3,000 each. Our cost of goods sold, if we make 300, is going to be 300 units times the 1380, and I'll link it over here. But if we manufactured 320 instead of 300, we're going to save that $5. So now I'm going to multiply that times the 1375, and our cost of goods sold is going to go down. So now if we subtract cost of goods sold from sales, we get a gross profit of $486 if we manufacture 300 and $487,500 if we manufacture 320. Again, we're not selling anymore. In the second column, we're just making more. So we're going to end up with 20 units in ending inventory. Our variable cost is $50 per unit. It's $15,000. And our fixed cost is, this is our selling administrative fixed cost, is $4,000. So our total selling expense in either scenario is going to be the same because it's based on what we sold. And so our operating income, which is the gross profit minus the selling and administrative, is $467 if we manufacture 300 and $468.5 if we manufacture 320. Again, we're not selling more, we're just making more. But where we're going to see the change is when we do our variable cost income statement. So let's put the heading in, and we will label it as a variable cost income statement. Same thing for, I'll just link it to up above because it's not going to change. So sales, of course, is not going to change. We're still selling 300 units, which is $900,000 in sales. But now, because we are recategorizing the expenses into their behavioral categories, variable cost up above, so our product cost is going to be the 300 units times 1,300. I can link it over here to my subschedule, which is 390,000. We have the same variable cost. If we manufacture 320, and now our selling expense, our variable selling expense is a $15,000, so we're moving that up above contribution margin. So our total variable cost is $405 in both situations because, again, variable costs would be based on what we sold. And if we subtract the variable cost from sales, we get contribution margin of $495. Our fixed overhead is still $24,000, but now we're just expensing it. So here's where the difference is going to come into play. Under a variable cost income statement, we just expense our fixed product cost. In this case, it's $24,000. We have $4,000 as fixed selling, so our total fixed is $28,000. And when we subtract those fixed costs from contribution margin, we get operating income or net income of $467. In this case, it's going to be the same whether we made 320,000 or we made 320 units, or if we made 300 units. That is really the focus of this whole chapter. And we can prove this by taking that ending inventory, which is 20 units, our fixed overhead per unit is $75, which is a difference of $1,500. And that's the difference between our two income statements. Absorption income. Variable income. And the difference. The difference between the variable income statement and the absorption income statement is the amount of fixed factory overhead in ending inventory. In this case, we were showing what would happen if we manufactured the exact number we sold, or if we manufactured 20 extra that would be in ending inventory. So let's move on to problem 19.2b. 19.2b is the Alante company. And they've asked us to prepare a variable income statement based on an absorption income statement that they provided in the textbook. Put the date, and this is based on sales of 250,000 units, which we sell for $18 a piece. So if I multiply 18 times 250,000, I get sales of 4.5 million. Again, the sales is not going to change from the sales presented in the book. Direct materials is $2. Direct labor is $2.40. Variable factory overhead is $1.60, and variable selling is $4. Again, we have recategorized the expenses into behavioral categories to put the variable cost up above and the fixed cost down below. So our contribution margin per unit is $8, and if we multiply each one of our variable costs times the number of units that we sold, 250,000 units, when we total it up, we get 2.5 million as our variable cost and 2 million as contribution margin. Then we can just subtract the fixed factory overhead, which is 450,000, and the selling and administrative expenses, which is $1.2 million. So our total fixed cost is $1,650,000, and operating income is contribution margin minus the fixed cost of $350,000. We can prove that by calculating the amount of fixed factory overhead in ending inventory. So the number of units in ending inventory is 50,000 because we made 300,000 and sold 250,000 units. Our fixed factory overhead per unit based on production of 300,000 is $1.50. So if we multiply 50,000 units in ending inventory times $1.50 of fixed factory overhead per unit, gives us $75,000. The absorption income statement in the book was $425,000, and when we subtract the fixed factory overhead in ending inventory, we get our variable cost income, which matches what we calculated in our variable income statement. Problem 19-2B. We're illustrating that the difference between absorption cost net income and variable cost net income is the amount of fixed factory overhead in ending inventory. And where this comes into play from a practical standpoint is where management might be inclined to overproduce in order to spread the fixed cost over a wider number of production units, and therefore driving down the per unit cost and increasing income. So in problem 19.3b, that's the exact scenario they're talking about. They're not happy with what income is going to be, and so the controller says, well, if we just make more units, then our per unit cost is going to go down, and therefore we will generate more income. But this is a misnomer, because all that's happening is we're putting more money into ending inventory, and therefore we have to store it, and it might be obsolete or whatever else. We also are going to have to pay the direct labor and the direct materials in order to manufacture it, so it's usually a bad idea. So this is the Chem Melt Company, and we're going to make an income statement under absorption costing, because that is generally accepted accounting principles. We cannot use variable costing for our financial statements that we publish, because it would violate the matching principle. Okay, in this case, we're also selling 250,000 units, which is $2 million in sales. Our direct materials is $2. Our direct materials and labor. Our fixed factory overhead, all the overhead in this case is fixed, times 250,000 is going to be 500,000 in direct materials and labor, $1 million in factory overhead. So our cost of goods sold is $1.5 million. Gross profit is 500,000. Our selling and administrative expenses are 450,000. So our operating income is 50,000. So they've gone from losing $150,000 to a profit of 50,000, and all they did was produce more units. They produced 300,000 instead of 250,000 that they normally produce. So if we take the $1.2 million and divide it by 300,000, there's our $4 fixed factory overhead. We had 50,000 units in ending inventory. So the $200,000 represents inventory that's still on the balance sheet, 200,000. The loss they presented in the book was 150,000. So merely by manufacturing 50,000 more pounds, this is a product that you throw on the street in order to, where it's cold and snowy, in order to keep the roads from icing up. But if they make 50,000 pounds more of it than they sell, well, their fixed cost per unit goes down and their net income goes up. And that is the point of this particular problem. So that's 3 problems in Chapter 19 that will help you understand the concept here. Again, the difference between the absorption cost income statement and the variable cost income statement is the amount of fixed factory overhead in ending inventory. Say that to yourself 5 times. That's it for now. I'll see you soon. Thanks for listening.